Hello viewers, we are going to discuss with you about buoyancy of stock market in the midst of distressed monetary policy measures of Reserve Bank of India and distressed and failed fiscal policy of Government of India and distressed financial sector. Here, Government of India is hiding behind RBI on payment of interest on loan moratorium. Secondly, on payment of GST compensation to states and insolvency and bankruptcy code. And finally, Government of India has surrendered before deficit financing, revenue deficit and deficit of GST and rising debt and borrowings. RBI has also surrendered before inflation, before declining growth rate, before rising effective real interest rate and buying massive bonds and securities from Government of India, while financial sector has also surrendered before capital scarcity, before massive rate cut, before lowest profitability rate and higher NPAs. Seeing this situation, RBI has infused massively cash liquidity and credit facility liquidities through banks, not through consumers. Here, RBI has infused rupees 10 lakh crores in cash liquidity through banks. But alas, everything is not in a good shape and economy is not responding properly to the monetary policy measures. Here, credit facilities as well as liquid cash facilities provided through banks have met buoyant stock market situation because of higher liquidity and lowest market return in business investment, where consumers lost, business confidence has been lost, consumers' confidence has been lost, where there is a supply crunch, where is a demand crunch, and economy is facing acute financial, monetary, and physical crisis. In this situation, taking this situation or making advantage in this situation, stock market is flying high, rising on the higher volatility index of stock market to get higher benefit. By leaving Reserve Bank of India in anxiety to ponder over as to how the stock market is buoyant, the stock market is growing higher and higher, while economy is declining lower and lower and has been pushed to the negative zone. This is a pertinent question before RBI and its impact of monetary policy measures along with failed fiscal policy measures, where the worst sufferers are financial sector, consumers, investors, borrowers, and lenders. This is the impact where RBI has been forced to think, where companies and firms' sales and profitability rate has gone down. Their balance sheet and asset quality has become worse. But as to how the stock market is flourishing, while economic growth is declining. This is the impact of massive infusion of cash liquidity through banks. Now we will see the massive credit facility infusion through banks. Here, out of this facility, non-performing loans has increased out of forced lending, out of loan melas and other government measures and forced government measures on banking and financial institutions to lend more and more in lieu of boosting economic growth. But here, economic growth has declined. In this situation, non-performing loans has become burden on the banking sector, and it has increased risk provisioning coverage ratio from 65% to 70%, and out of their profit earnings in the midst of massive rate cut, where profitability is the lowest one. And out of it, they are eating away the capital of lenders. Profitability rate of lenders, and this has increased the credit cost of lenders from 2.5% to 3%. Seeing this situation, Moody's, a rating agency, has said that in coming 2 years, the lenders, especially public sector banks, is going to face recapitalization problem about rupees 2 lakh crores. This is a highly deplorable condition and financial situation of lenders where capital is scarce in the midst of massive credit infusion, massive cash liquidity infusion. Virtually, in this situation, the stock market is buoyant and stock market is reaping a higher benefit, where retail investors, crony capitalists, business investors, and other financial depositors who are investing their cash liquidity into the capital market out of distressed market situation, out of lowest supply and lowest demand condition, where market is depressed, where consumers have lost their confidence, where business have lost their confidence in the business market situation, where market has become a riskier one, where stock market is giving a better profit to our investors. Seeing this situation, it becomes clear that RBI has not become able to properly assess the market or business market situation and capital market situation and mood of consumers, mood of investors, mood of lenders and borrowers. They all are depressed because of non-responsive monetary policies of RBI. RBI's monetary policies, along with failed fiscal policies of Government of India, have made the situation worst, where GDP growth has been pushed to the negative zone while economy is burdened with debt and higher borrowings, where government of India is curtailing capital expenditure for growth. Seeing this situation, it is borrowers, lenders, investors, and other depositors are losing their faith in RBI's monetary policy measures, where Government of India's failed fiscal policy measures is putting extra burden and forcing lenders to lend enormously at the lowest lending rate, and out of it the capital as well as asset quality and balance sheet of lenders are becoming worst. This is not a good situation. To improve this situation, RBI's monetary policies should be reviewed in the context of prevailing Indian economic situation, where Indian economic situation are not responding properly in the midst of failed fiscal policy measures, where the purchasing power is the lowest one, where joblessness is the highest one, where revenue is the lowest one, and RBI is made a tool by Government of India to face these physical as well as monetary and financial situation where RBI is not performing up to the expectations of Indian economy, and where in the midst of weaker fundamentals of Indian economy, it becomes difficult for RBI to face this situation. So it is a failure and total failure of monetary policy measures along with fiscal policy measures of Government of India, and who have forced to the financial institution to face the worst situation and has finally pushed GDP growth rate towards negative zone. This is a prominent economic crisis before financial institution, before other lending institutions. This is a critical situation, and we are putting this problem before our viewers, our economists, our financial institutions to solve these problems properly in the interest of nation, in the interest of economy, for boost of higher growth rate, for creating higher jobs and higher purchasing power through consumers, not through banks, not through lenders, because we have seen the massive credit infusion of RBI and massive credit cash liquidity infusion of RBI and its impact on the economy. Thanks, a lot of thanks to my viewers.